Hello everybody and welcome back. In this video, I want to talk about 3 stocks I would buy right now if I was creating a portfolio from scratch. 3 ideas, 3 stocks that I think are of very good quality companies available at a reasonable price. So if you are hesitating right now whether you want to build your portfolio or you should wait for a drawdown in stock prices, I think these are 3 very good opportunities. And if you want to make some good performance in the future, this could be a good portfolio. So 3 stocks, I want to talk about specific stocks. What is their growth rate? What is their competitive advantage? What is their valuation? So you can make an informed decision whether you want to buy them or not. Okay, so we can start. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I own some of them. I own 2 of these 3 stocks. So I invest only in quality companies. These are very high quality companies. And I want to start with the one that I don't own. Okay, I want to start right now with Microsoft. If I wanted to create a portfolio right now from scratch and I wanted to build a strong portfolio with strong companies, the first idea would be Microsoft, because Microsoft is a gem of a business. They have been operating for so many decades now. You have an excellent management team, some very strong assets, an immense pricing power. You have a very good quality company, and now the stock is down a little bit now. Okay, we are in a 10% drawdown as I'm recording this video. You see here below high 10%. So the stock is down a little bit and the valuation is now reasonable. So Microsoft, it dominates in key market. You order the Windows, Office, Asia with strong pricing power. Every couple of years, they have the potential to increase the prices of the back office, and customers do not change. Customers do not change providers because you have a lot of stickiness when it comes to their products, their services, which creates immense pricing power. Now they are, even right now, increasing the prices for the back office, Word, Excel, PowerPoint, because of AI. They say they are implementing AI, so because of this implementation, we are raising our prices. Customers complain, but customers pay. You don't have a lot of businesses like this, where every couple of years, customers complain, but customers have no choice. What are you going to do? You go to change to Google Sheet for the free version? If your whole company depends and relies on Excel, will you really change the backbone of your company just for cheapness? I don't think so. You like to stay with Excel because your whole company with all your employees rely on Excel. You have a cloud linked with Excel. All the documents are in Excel. It will be a pain in the neck to change. So what are you going to do? Pay up plus 20%. That's it. You will not change for a cheap alternative. And it has been the case for years and years and years. So Microsoft has immense pricing power. In a world with inflation, like today, you want to be invested in companies with pricing power. You want companies with a moat. Microsoft has a moat. Microsoft has pricing power. Okay? So only these 2 attributes makes Microsoft a very good business model, a very good stock to own for the next 5 to 10 years. Second point, you have high margins. You have recurring revenue from cloud and software subscriptions. Yes, the margins right now, the gross margins for Microsoft are in the 70s, operating margins of 46%, net margins of 35%, and the margins are increasing. Okay, if you look at the growth rate for revenue up and to the right, net income up and to the right, free cash flow, look at this. Free cash flow up and to the right. You don't have a lot of problems when it comes to efficiency. Microsoft is very efficient. They know where to focus their energy and it is working. And if you had spotted these attributes a couple of years ago, 10 years ago, you would have been a very happy shareholder. And along the way, as the business got better, the stock went up and up and up. And every time Microsoft proved the world it was, and it still is, a leader, a leading company. 3. Excellent capital allocation and consistent buybacks. As you can see here from this chart below, in green, this is the buyback. How many shares are you repurchasing every year? If the green candle is big, it means a lot of buybacks. So they bought back, 2% of their shares, 1%, 1%, 1%, 1% of their shares. And they recently stopped. At the same time, they have a small dividend yield of 0.7%. So small buybacks, small dividend yield, and you have a minimal capex compared to other Magnificent 7 companies. Which means if you look at Amazon, a lot of capex, a lot of investments for AI. If you look at Google, a lot of capex, a lot of investments in AI. Meta platforms, a lot of capex that reduces the free cash flow. And Microsoft is, the company that invests a very minimal amount in capex. They don't want to burn billions and billions and billions of dollars, an infinite amount of billions of dollars into capex and AI. They are fine. They are investing a lot, but not too much. Okay, not like Google or Meta platforms. Google, Meta platforms, Amazon are almost reinvesting all their free cash flow right now. And if you listen to them, they want to take on more debt to invest more in capex. Microsoft is not doing this. Okay, so yeah, pretty good distinction between Microsoft and the other leading tech companies. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. You have a strong balance sheet. Oh, you got spoiled. You have a strong balance sheet with a lot of cash, very good credit rating. You have a company that is very resilient, and anybody would lend money to Microsoft. In case we have a crash in the economy, anybody would give a loan to Microsoft. So this is fine. You have a long-term compounding machine driven by AI. They can implement AI everywhere. Cloud, this is one of the 3 hyperscalers, and enterprise software. And you have a deal with OpenAI. A couple of years ago, they made a deal with OpenAI and ChatGPT, which means if OpenAI rules the world, if OpenAI becomes public with an IPO valued at $1 trillion, Microsoft will benefit. So I see this as a call option, right? They have some ownership with Sam Altman and his team. If OpenAI fails, it's okay, because they have not taken a huge investment in OpenAI. But if ChatGPT wins and becomes big, raises some good capital in the future, if ChatGPT becomes profitable 5 years from now, Microsoft will benefit. So Microsoft is not spending hundreds of billions of dollars in capex, but they are investing in a smart way, prudent way. You make small bets, small investments. If they fail, it's okay. If they become home runs, you benefit largely. Additionally, you have other platforms for Microsoft like LinkedIn, like small incremental revenue streams that are coming to fruition. So yeah, a lot of ways to monetize the business model. And because of subscriptions, you know with pretty good accuracy what the business will look like in the next 5 years. Look at this chart from the revenue. Literally up and to the right, because they have a lot of subscriptions and they can just increase the prices. And I'm telling you, they have a lot of potential to increase prices by a lot more. So if I had to start a portfolio from scratch, I would consider Microsoft. Now that the stock has dropped a little bit, it has become reasonably valued, and the quality of the business model is immense pricing power, immense leadership, quality management team. Mr. Nadella is great, a cloud, growing Asia a lot, plenty of tailwinds. And now the forward PE ratio is 29, which is okay, which is reasonable, right? For this kind of a quality beast, paying a PE ratio of 29 is good, I would say. Pretty good. So if I wanted to start a portfolio right now, I would consider Microsoft. a lot. Second stock is Mastercard. Mastercard is an even more simple business to understand. It's the global toll booth on digital payments. They take a cut from every transaction. Very simple to understand this. It's capital light. You have very high margins. You have 80% gross margins here, as you can see, operating margins of 50%, 60%, net margins of 40%. The business is going up and to the right, no disruption. Look at this, revenue up and to the right, net income up and to the right, free cash flow up and to the right. They don't have capex at all. It's a very asset-light, efficient business model. Nothing can really disrupt Mastercard. The same thing is true for Visa, by the way. And the stock is just a compounding machine, okay? You have huge runway in emerging markets where cash still dominates. As the world is going more digital, people will use more cards, people will use Mastercard and Visa a lot more in the future. You have a duopoly right now with Visa and Mastercard. It doesn't matter which one you choose. You don't have a lot of differences between the two companies. Mastercard is a little bit more focused on value-added services like information, data, but Visa is also doing this to some extent. So you don't have a lot of differences between Visa and Mastercard. And these two companies are inflation hedges. So Mastercard earns more as prices rise and people spend more because Mastercard takes a cut, like a royalty company, a small percentage on all the transactions, every transactions, which means if you have a lot of inflation and for some reason grocery prices double, well, Mastercard takes a percentage. So in amount, in absolute amount, if the percentage is the same, let's say it's 1%, and the volume doubles in absolute terms, Mastercard will get twice the revenue, twice the royalty stream. So yeah, it's the perfect inflation hedge. They have extremely high return on invested capital and durable competitive advantage. You have big network effects. And now Mastercard is dropping a little bit and we are 9% below highs. And the forward PE ratio is 28 for this company. So not very expensive for the kind of quality company Mastercard has. If you look at the price to free cash flow, you are at 30 right now, but the forward price to free cash flow is more 26, 27. I would say 27. So same thing. The company is doing buybacks every year. They are buying back 2 or 3% of their shares every year, as you can see here. They don't have a debt problem. They have, what is that? Debt of $18 billion, cash of $8 billion. So net debt, that's debt minus cash, of $10 billion. Net debt of $10 million, right? And they produce how much cash flow every year? They produce $13 billion of free cash flow every year. So in 1 year, if they want, they can remove the debt, pay off the debt very easily. And they generate a lot of cash flows. They, look at this, the difference between operating cash flows and free cash flow is minimal. In yellow, that's the operating cash flow. In blue, that's the free cash flow. This is almost the same. And the only difference is the capex. For Microsoft, you have a difference between the blue and the yellow. Look at this. In the past, you didn't have a lot of difference. And now you have a larger discrepancy, a larger gap between the yellow line and the blue line. The difference is the capex. AI investments, okay? More data centers. For Mastercard, you don't have this. You don't have a gap. You have the same amount, the same discrepancy for years and years and years. Mastercard doesn't need to invest in capex. So all the cash flow is for you, the shareholder. And they are paying a small dividend, a small buyback policy here. And they are paying a small dividend too, 0.5% dividend yield. So it's a perfect inflation hedge for a resilient compounding machine. And now it's reasonably priced. So if I wanted to start a portfolio today, I would consider Mastercard in a big way, in a big way. I am a shareholder of Mastercard. It's roughly 9% of my portfolio today. And I want to increase the exposure because the stock has dropped, the valuation has dropped. It's one of the best opportunities I see in this market right now. And it's a big company, right? The market cap is $500 billion. Where do you think the market cap will be in the next 5 to 10 years? The business can continue to grow at 10, 15% per year for many years. And if you have inflation, they will grow by more than this. It's the definition of a high quality premium company available at a fair price. Third company I want to mention is MSCI. I am a shareholder of MSCI also. It's what, 7%, 8% of my portfolio. It's a monopoly-like business in financial indices. So, you can benchmark your performance with big indices like the S&P 500 or the MSCI World. Well, there is a company behind this index called MSCI. And they have a locked-in client base. This is very recurring also. Asset managers can't operate without their benchmarks. It's similar. You have a subscription run rate. Fund managers are forced to pay MSCI to benchmark their performance against the MSCI. So they have to pay a fee to use the MSCI every day. And if you are, I know this very well because I am in this industry. If you are a fund manager, you are forced to pay your benchmark provider. You are forced to pay MSCI a lot of money to have all your risk profiles, depending on all your risk assessments on all your stocks in your portfolio. Stocks, bonds, commodities, hedges, everything. You need to pay MSCI. And MSCI has created such a huge collection of data. Fund managers cannot work without this business. If you are using MSCI, it's very hard to change your data provider. It's very hard to change your benchmark. And I would say almost impossible to change your benchmark. Because if you are a fund manager and for the past 15 years, you've been comparing your fund with MSCI World, what would it cost to change your benchmark? It would cost your reputation. And clients will not like this at all. So if you are benchmarking your fund with MSCI World, you will continue to pay MSCI for many years to come. You have this benchmark, but also the risk profiles, also all the data with MSCI One, the big super app that MSCI created in 2021, 2022. And you have the ESG metrics, sustainability metrics, private assets metrics. Everything is integrated so the clients are locked in. Literally, you are inside a loop and you can't get out of this loop. You have a lot of stickiness for MSCI. And MSCI is very smart about it. They are raising their prices slowly but surely. So the revenue is going up. If you look at MSCI, they have extremely high margins. Gross margins of 80%, net margins of 40%. And look at the revenue. Every year, they are raising prices. Every year, they are getting more volumes, more clients. The revenue is trending up nicely every year. The net income is trending up every year nicely. The free cash flow is going up every year nicely, right? So very asset light, very efficient, subscription business model, subscription-based business model. You have high switching cost and recurring revenue model. Margins are very high, around 50%, and you have an excellent free cash flow conversion. If you compare the free cash flow to the net income, it's almost the same. All the net income is translated into free cash flow. And similarly to what we've seen for Mastercard, you don't have CapEx. You don't have a difference between operating cash flow and free cash flow. Look at the two lines here. In blue and in yellow, you are talking about the same lines. So no CapEx. No risk of over-investment in AI for data centers. No. Not at all. It's an asset-light company, efficiency beast. They don't invest in new data centers, a lot of CapEx. What if we overbuild in the future? They don't have this risk. It's an asset-light business model with extraordinary margins, okay? And you have massive buybacks. In 2015, they started the buyback program with an activist called Value Act. And they continued their buyback philosophy, okay? And when the stock is cheap, when the management thinks the stock is cheap, the management team increases the buyback program. And in the last quarter, they announced a brand new buyback program. So they are very how you say, efficient when it comes to capital allocation right now. As you can see here on a quarterly basis, you have a green candle that is very high. So in one quarter, MSCI bought back 3% of their shares, which means the CEO and the management team think that the stock is cheap. And every time they did buybacks, it was the local bottom for the stock. So we will see if this is the case. But for the past 4 years, the stock has gone nowhere because valuation was extremely high and then valuation came down. And now we are at a forward PE ratio of 29. Okay? The forward price to free cash flow is a little bit below than this. So same thing, same philosophy, high quality compounder, premium company available at a fair price. Okay, so this is a very good candidate, and I would include MSCI in a brand new portfolio if I wanted to start a portfolio today. Okay, so each of these three businesses, Microsoft, Mastercard, and MSCI, are durable, scalable, with a high return, hard to disrupt, and shareholder friendly. They pay dividends, they do buybacks, they have fat margins, and they are leaders in their category. So now all of these three stocks are reasonably priced. You have reasonable valuations for the three of them. MSCI right now is 15%, 16% below highs. And I think if you buy right now, you have good chances of outperforming the market. I'm a shareholder for MSCI, I'm a shareholder for Mastercard, and I'm still studying Microsoft. But I think Microsoft is a very good investment right now. So these were three companies I would buy right now if I was creating a portfolio from scratch. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.